and gentlemen, welcome to the Business Brew. I am your host, Bill Brewster. This episode features Keith Smith. Keith is a guy that I have known for a while. Met him through Manual of Ideas, as I met many of my guests through. Shout out to John and the crew over there. Keith stops by. We have a conversation about a lot of topics that are areas of interest that don't often come up. So I hope that y'all enjoy this. And shout out to DeLupa. The sponsorship has formally ended, but I will continue to sing their praises and say that if you are looking for a spreadsheet that has auditable information and you're looking for something that has KPIs on basically every number that a company has disclosed over the past 10 years, they are a solid option to check out. And I appreciate their support, and I will continue to use their product. As always, nothing in this episode is financial advice. All of the information contained in this program is for educational and entertainment purposes only. Do your own due diligence. If you hear anything on any podcast, you should assume it is opinion and verify for yourself. I wouldn't even say trust it. Anyway, consult your financial advisors before making investment decisions and do your own due diligence. Enjoy the show. All right, ladies and gentlemen, Keith Smith in the house. How's it going, Keith?
Good. It's actually one of the rare warmer days up here in the north. I think it's going to get cold again, but hopefully we'll at least get another day of warmth before it starts the temperatures stay down for a while. So,
well, may you enjoy them while they last. What's we were talking a little bit offline, and then we got into a topic, and then I said let's just turn the recording on and then see how it goes. So, what were you going to hit me with?
Sure. So there's actually a really interesting article from the Morgan Stanley, the list of articles that he's come up with over the years, which have been really good. This one talks about the life cycles of companies and returns on invested capital. And they have a pretty good definition of companies in different stages. So you've got sort of the introductory stage, where it's basically just a business plan, a growth stage, which they define as you're investing more than you're actually generating from cash flow from operations, so you have to fund it usually from some outside source. Yep. The third area is maturity. That's the point where you're generating more from cash flow than you're investing in the business. And then you get into sort of shakeout and decline, which is where the actual cash flow from operations is declining, and it's more of a capital return aspect. And it's a really nice framework he goes through, and he talks about the returns on capital of each. And he has this really interesting table in there, which basically shows the returns on stocks as they transition from one stage of development to another. And what to me, how that really helps me sort of explain sort of me as an investor, how I've sort of over time have transitioned from where did I initially find some really good investments, and then continuing to invest in that strategy has been more of a challenge. And so what we've done at Bonhoeffer is we've evolved in our strategy and looked at more internal growth of the business and you can see in this framework sort of how we've sort of gone from one part of this matrix to another. You want to try and probably include a combination of a number of them, but it's a different mode of thinking. So if you're in a business where the focus is capital returns and you're an investor, you're really focusing on a different set of metrics than, let's say, if you're in a growth stage. But where initially, I personally, before I started the fund, did relatively well, is going for companies that were sort of in declining businesses that basically transferred to growth businesses or mature businesses. That transition creates, I think, the highest rates of return. So what they did is they did this study that was about 20 years, and they categorized companies in each of these different buckets. And then they looked at the returns those companies had, just in general, and then when they transitioned from one bucket to another. And so initially, the areas that I was focusing on was going from more of the decline and shakeout to, call it, the maturity part of the business, and even growth. And the annual rates of return of those sort of types of businesses have been like 13 to 20% annually is typically what those kind of businesses have done.
So what are you looking for in that scenario? You're looking for a business unit within a declining business that's going to grow and sort of start to overtake the decline and turn it back into a growth business?
Exactly. And so that's what I think a lot of value investors try to do. And, I think the success rate in that can be, if you start out initially, my success rate was relatively good, but as time went on, the success rate went down. And then therefore, because if you stay in sort of that decline rate and you don't escape out of it, this matrix also says the returns on companies that are in decline rates and still stay in decline rates is down by 3 to 4% per year. You almost have sort of like this probability of, okay, how many of these businesses can you find that are going to transition to a higher number versus the ones that are sort of in decline? They're just going to go into decline and just stay there. And so it's really that aspect, I think, that explains. So when I started Bonhoeffer, before I started Bonhoeffer, I did a lot of personal investing. A lot of it was sort of in the radio media type of in telecom businesses that really got a bump after 2008, 2009 in that time frame, where basically after 2008, 2009, a lot of these were sort of left for dead. And then when people realized, okay, these things aren't going to die, then all of a sudden the returns were just tremendous. What happened?
But is that a stock issue or is that an underlying business issue? I guess in 08 and 09, it was a little bit of everything.
You can say it's a stock issue. I think if it's a short-term thing, maybe 6 months. But I think the overall economics is reflected in the stock. So over the time, it does become an underlying business issue. Because what had happened was those businesses were in decline, but the market thought they were going to decline like right away. But what had actually happened is it took them a lot longer. Eventually, they did decline. And I think that's a trap that value people have to be careful of, is that if you're in a business that's declining, the market thinks it's going to decline quicker than it does, and you get this bounce back up, unless the business actually starts growing again at some point, you're going to get caught in the down slope after it recovers. It's more of just like a dead cat bounce to a certain extent on a longer term basis.
Yeah.
And so, I mean, what we've sort of done at Bonhoeffer is we've sort of thought about, okay, what's really driving these returns on capital, and what are the key pieces that really drive the returns on capital from the operational business perspective. And so if you look at businesses, you're saying, okay, well, you want to buy, optimally, you'd like to buy a business that's going to be growing over time on a per share basis. There's a few ways you can do that, but the best way to do it is to have a little bit of growth, a little bit of organic growth, and that can be enhanced by acquisitions and or buybacks to sort of create a lever. I mean, the way I look at buybacks is just leverage, right? So whatever the underlying business is going to do over time on a per share basis, buybacks will either enhance it if it's going to go up, or will make it worse if the business is actually getting worse and you're buying it. So because the way I think about it is saying, okay, what I'm buying with a buyback today is I'm buying a piece of a company 5 to 10 years from now. And if I think the company is going to be worth less 5 to 10 years from now, I wouldn't want to buy it back. I probably would want to distribute it in distributions, and you just get the cash back. But if you think the business is going to be worth more in the future, then you'd want to buy it back. So it's almost it's somewhat of a leverage bet on what the business is. So it's a way to gain leverage without actually getting financial leverage in the business.
Yeah, when you say worth more, you mean like on a real basis, because exactly. The business should, the value should go up with inflation theoretically, I would think, right?
That's right. But overall, if you just think about businesses in general, they all have a tendency to decline. I mean, we're all in this situation where businesses go good, but they have this huge headwind of competition that's constantly eroding, on average, the business over time. Business values as competition that's eroding these profits away over time.
That's why you got to find those government grifts, man. Those stick around.
Well, it's interesting, like you're saying, and there are some interesting government grifts. I guess in banking,
it's
right?
The best game.
I mean, because some of the you look at some of the incentives that the government has provided for banks, like these ESIP banks, where they gave them a bunch of capital for little or no cost, right? And so if you've got a bank that really has done a good job, and there's a lot of other incentives that are sort of in this low income type of area, there are a few banks I think that have done a really good job and done a good job of underwriting, and those banks are going to do well. But if you're given this in essence this huge subsidy, but then you end up investing it in loans that go bad, then it really doesn't help anybody, right? In essence, you're just going to end up, and those banks are the ones that really don't, I think are the ones I'm not as interested in. I'm more interested in the banks that basically have a good record of return on equity with relatively low losses and can do that going forward. Sort of that's the repeatable process. And when they got all this money, like the ESIP money, some banks spent a bunch of it right away, and other ones basically spent their time on underwriting good loans that they felt they could get a reasonable return on. But I think what I've done, and just going back to sort of this Mabosian thing, I mean, I think the one way to sort of think about a lot of this stuff is to say, okay, well, what's the required rate of return that you should get if you're an equity investor, right? And so the required rate of return you should get in an equity investor should be higher than what you could get on debt, right? So if you look at right now, you can go out and buy one of these well underwritten BDCs and probably get, I don't know, 13 to 14% return. So you're talking about, let's just say 12 to 13.
Now, is that variable?
That's variable
right?
Rate, yeah. But
so
still,
what, on the low end, you're going to be looking at 9 or 8? Like, let's say that rates go back to 0 like they were. Where do you think you end up?
Well, if rates go back to 0, then yeah, so you subtract 5 from that. So yeah, so I mean, if we're talking 13, so you're talking about 8 or 9. But I guess the question is that as an investor, at least my process would be to assume that we don't necessarily go back there, but let's say we stay higher for longer. Then your benchmark is 12 to 13%. And then you say, okay, well, that's just for debt that you know you're going to get repaid back. You're going to get interest during that period of time. If you're going to invest in equity, you need to have a higher rate of return, right? So let's say you have to have 5%. So you're talking like high teens, low 20% sort of rate of return for equity to even make sense.
So let's talk about these BDCs.
Yeah.
What kind of risks, like what are the underlying assets that are generating the returns of 13% or 12 or 11 or whatever? Knowing that this is all forward looking and who knows that the returns actually come, right? This is
I mean, you can take a look at the track record of these guys and get an idea of what types of returns have they been able to generate. So if you take a look at like probably one of the better ones that I know the guys that actually, because I used to work with them in a commercial bank, is like Sixth Street. Because so Sixth Street is probably one of the better performing BDCs. It's generated about 13% since it went public in 2014. So in this lower interest rate environment, from 2014 to now, it's been somewhat lower interest rates. So I mean, maybe that's sort of, let's say, call that sort of the benchmark. And they've done that with relatively low losses. I think their losses are like 0.6% in terms of that. The realized losses are actually 0 because they actually got gains in other areas that they've been able to do. So basically the net realized losses are actually 0. So overall, I mean, the way to think about BDCs, the guys at Sixth Street probably have the best way to do it is they break it down. They have unit economics. They break down each loan by unit economics, and they say, okay, here's the amount that we can make on interest. Here's the amount we're going to make on fees. That gives you a total return. We're going to lever it up. Most of these guys are levered up. And so right now, like Sixth Street, if you look at their numbers, they're getting like 18.5% pre-fee type of situation. And the fees for Sixth Street's probably around 37%, which is equivalent to, like, let's say, an efficiency ratio, which is sort of another banking term that's equal to. And so, the net returns probably historically has been around 13%. But that 13% has been when the risk-free rate has been when it's been lower. Now that it's higher, you're probably talking about, mid-teens percent return on equity. It's selling at a little bit of a premium, so maybe get like 13-14% sort of total returns. What these loans are, the BDCs cover a lot of different, they're basically private debt that's provided to companies. It has a downside that it's not really liquid, the debt itself. A lot of them, some of them are fixed, but many of them are variable rate. But the key thing you really need to take a look at is the underlying portfolio and see what type of coverage ratio and growth the underlying companies in the portfolio really have. So if you look at somebody like Sixth Street, I mean, their coverage ratio is about 2 times, which is higher than the average. I mean, the average, I think, is like 1.3 or something like that. And the portfolio is growing at low double-digit rates EBITDA. So what's really interesting is if you look at as interest rates have gone up, the underlying growth in EBITDA in these businesses basically has somewhat, their interest coverage ratio has been flat, even though the interest rates have gone up, because these variable rates just go up as it's a LIBOR plus, so you're going to end up with a interest rate that's bumping up. Now, the other thing too about the businesses, Sixth Street in particular, other guys do different things. What they focus on is they focus on businesses that are not capital intensive, which helps out a lot, right? Because if you get something that's growing, I call it mid-teens, that's not capital intensive, then you really can use EBITDA as a decent measure of what earnings is, because there's not going to be much DA, right? I mean, it's just not. Or the you have there is going to be sort of acquisition stuff that's really not relevant going forward per se. Call it.
Yeah, I guess you got to worry about your LG. Like if there's a loss, your loss given default, if it's not capital intensive, you're kind of relying on the IP and that. Like,
well, that's
you know what I'm
true.
saying?
Yeah.
Your loss ratio should theoretically be higher in asset light businesses, or your loss given default should be higher in asset light businesses.
Okay.
But your probability default might be quite a bit high or lower.
Yeah, no, that's true. I mean, the one thing that I do know about the guys at Sixth Street is that they do a really good job of underwriting. That's the one thing that's a difficult thing about BDCs is trying to evaluate management and knowing specifically what does their underwriting process look like. I mean, and I have a little bit of insight in terms of what these guys did at a previous location and what the underwriting process looked like there, and it was really solid. I mean, when they were working for a private bank, they basically had no defaults. And the one default they had, they were able to find a buyer that basically was able to buy them out, and so it says they in essence had no defaults in the portfolio.
Yeah. Are you first lien here? What are you normally in these BDCs?
Well, it can vary. I mean, the ones that I really like are the ones where it's primarily first lien, senior secured, or you can get some really unusual structures. Like one thing that Sixth Street does, which I haven't really seen anyone else do, but other people could do, is they'll basically go, like, for example, for what they did this with Sears Holdings, they did this with Payless. Before the company's going bankrupt, they provide them a retail ABL line that's first in the line of creditors. So when then the company goes bankrupt, then they flip it to a DIP. And then they get the first lien DIP. And so in those transactions, they've been able to make it low 20% IRRs on that type of stuff.
Interesting.
Which is,
DIP is debtor in possession for those that don't know.
That's right. Yeah. So it's an interesting little niche, but I think that was sort of stuff that they had developed where they were at the bank, and they also had some expertise in terms of factoring from when they worked at a bank. That same group did the same thing. But what I found interesting is this company at the bank, the guy that was actually the head underwriter, and a lot of the big guys that brought in a lot of the business for the bank historically, went off and started a BDC. So you don't see many BDCs started by a bunch of guys that used to work at a commercial bank. Most of them are led by either high yield or private equity guys or something like that. And I think that's what, in my mind, what makes a big difference from a cultural perspective is, these guys, this is the way they started out in banking. This is what they learned. This is the processes they learned. And this is how they do stuff. And therefore, that sort of carried on into the BDC, I think, which is somewhat...
Were they in credit or were they more on the line, like originating?
They were in credit. I mean, what they did is at the time, they actually made loans to software companies based on annual recurring revenue.
Huh.
And really? So that's the one model. That's the model that we helped them with in terms of doing that type of work. When I was, because I my background is business appraisal, and so we work with them to develop this model and coming up with, we do the software company. And the opportunity for them was after the .com boom, all the banks were running for the hills on anything that was associated with technology. So whether it was good technology, which is software, high recurring revenue, or hardware maintenance or something, which is really bad, really a tough, much more tougher business, everybody was running for the hills. So they would get all these banking relationships as a result of that. And then in addition, they had some relationships with private equity. And so the whole thing just sort of, over time sort of snowballed. I mean, the other thing that they actually did, and you can see this in some of their, the guy that runs it, Josh Easterly, has really great conference calls. I mean, he's very, very transparent, and him and his team, both Stanley and the other guys, they're very, very transparent in terms of what they do. It's really interesting because he's a value investor, and you can see him actually implementing value investing in high yield type situations. And so it's over time, it's been really interesting. Just it's probably in terms of conference calls, I think it's probably one of the most interesting because they'll actually get in and discuss some of the deals they're doing in terms of what's really going on, as opposed to, and they, they're going to tell you the metrics. I mean, the metrics are best in class in terms of everything that they do. I think the only BDC that has a higher coverage ratio than them is Oaktree, but they're, I mean, the way I've sort of, from a safety perspective, the way I sort of categorize BDCs is you got two of them that have high coverage ratios. And this is portfolio coverage ratios. and in addition to have growing EBITDA, and that's Oaktree and Sixth Street. And what's different about them also is they both have very good distressed experience. So they got those two guys, and then you have the bigger guys. I'd say are a little bit different. I think they're going to do well, but their portfolios have higher losses. And again, the coverage ratios are lower for those ones. And those are guys like Ares, Blackstone, Owl Creek. So I mean, those are probably, I don't necessarily call them tier two, but I think they're not, in my mind, they're not quite the quality as the top two guys. And then there's everybody else, and mostly everyone else has been a disaster over time. That's why most people haven't even been interested in BDCs, because most of them are a disaster. I mean, it's a very challenging business from that perspective. And so there's been a lot of losses over time. There's been a lot of
It's like kind of it's tax advantage. Aren't most of them tax advantaged?
Yeah. So
okay.
They don't have to pay taxes.
Structured like a REIT and formed for the purpose of basically lending and developing business, hence business development companies, right?
Exactly. Yeah.
Yeah.
And I've seen.
So if you give a bunch of people a bunch of incentives to go out and lend money, in general, that space may not turn out so hot.
That's right. Exactly.
Yeah.
I mean, there's one thing you can take a look at in my mind. These companies report return on equity. So all you got to do is just sort them by return on equity over the past 5 to 10 years. And it clearly lays out, okay, these guys are doing good, guys. These guys are, and there's a huge difference between the two, and it's very segmented from that perspective. But yeah.
I guess. I mean, you could get adverse selection, right? The way that returns theoretically should work is the higher returns on equity should probably have more risk in them. But I don't disagree with what you're saying. I'm just
that's why
pointing that potential issue out.
Oh no, I agree. But I think it's important to take a look at it over a few cycles, right? So you want. Yeah. So if you go back to like the early 2010s, that would have probably typically these loans have like 3 to 5 year duration. So if you go back to 2010, you're probably going to get 3 to 4 cycles to get an idea of what's really going on with the loan book. And you can
who's going to these guys instead of going to your commercial bank? Like, what's the advantage to the borrower of going to a BDC instead of a commercial bank?
It's flexibility, and a lot of the commercial banks are stepping away from this business because of the amount of capital they have to put against these types of loans. So you're generally talking about, for the most part, best double B, and a lot of probably triple C type loans you're talking about here. So the banks just have not. I mean, the guys that have been in this market before have actually been high yield. But what's actually happened with high yield's migrated, right? Their credit ratings have gotten better, and the guys that the lower ends that fell out of high yield have gone to private credit. But, and private credit, like saying that, in my mind, that leads to a really rich field. But you just need to have a good underwriter, right? I mean, if your underwriter is terrible, you can blow yourself up easily, which is what's happened to a lot. Not necessarily blow. It's not. I guess it's not as concerned as blow yourself up, but your returns are really going to be subpar, right? I mean, you'll get like 5% returns, and for taking this kind of risk, 5 to 6% returns are not. I think you're taking a lot of risk for getting 5 to 6%.
Yeah.
And so, but yeah, it's an interesting space. And I think if you segment it along those lines, you'll clearly see the differences. And right now, what's interesting, so if you use that, let's say, as sort of the baseline, I like using it as sort of a baseline. Okay, if I go out, I can go out and buy a BDC and get 12 to 13%. So then this is different than it was, let's say, 2-3 years ago when interest rates were 5% lower and that benchmark was 7 to 8%. Now that it's 12 to 13%, it's like, okay, if I'm going to go out and buy an equity, 12 to 13% doesn't seem to be too exciting anymore, because I can go out and get first lien secured debt, get this money in cash. Like you're saying, they're not paying any taxes, so you're receiving that in your pocket all the time. If that's sort of where the alternative investment is, then all of a sudden your rate of return to get the higher numbers is higher. So I mean, what I've sort of, at least from a mental model perspective, have tried to look at is, okay, I've gone through the portfolio. What we've done is we've removed securities that had like lower rates of return, and we're looking like to get 15 to 20% or higher sort of rates of return, in total return being defined as a combination of, basically reinvested return on equity plus dividends. And so it's so it leads to sort of what it does. It leads you to sort of certain areas where there's, it reduces the field quite a bit from that perspective. Now, if interest rates go down, like you're saying, if interest rates return back down to zero, then all of a sudden, a lot of these things that are probably that have a low teens to high single digit returns actually become much more favorable again. But right now, a lot of those are sort of, I would say, sort of, you know, underwater on a risk return basis, I guess you could say.
Yeah, and from a portfolio, you don't have to be long only one thing, so it makes some sense potentially. How levered are these portfolio companies? Like 5, 6 times, 4 times?
Some are, and again, it depends on now. I think the detached points for Sixth Street, again, theirs is the low. I think it's like average of 4.5. So
Okay.
they're on the low end. But again, I mean, it's a publicly traded security, so I can go out and buy that tomorrow, and that's sort of what I use as a benchmark. But some of them are 5 or 6. Yeah, when you get to 5, 6, or 7, then that's that's the bigger issue. Some of these guys also probably have more flexibility if they're in the first stage. They probably can, they may be in a better position in terms of dealing with the company in terms of not having other people in the deal from that perspective. But still,
Yeah, so you don't have to deal with a bank group. You don't have to have some sub debt lender and do all those. So basically, you've got like one credit agreement, one person to deal with. That's sort of the value proposition of this niche.
Yeah, especially for the guys that are like Blackstone secured lending, who's basically lending to primarily Blackstone private equity clients. I mean, it's all one. You're saying it's all one person from that.
Seems a bit incestuous, but okay.
Well, yeah, that's the other issue with these businesses. Is most of them are externally managed. So what you end up with is there's lots of conflicts of interest that need to really be sort of satisfied. Now, what's interesting about Sixth Street is Sixth Street has an agreement with the underlying asset management company that they get the first dibs on any loan that's originated by their credit group in North America, which is unusual. Most of them, I haven't seen this in that way. So they're as part of the Sixth Street, they're generating all these loans, but Sixth Street gets the first dibs on any of those loans to be part of the BDC. And I think that, at least in my mind, is signaling that these guys recognize there's a conflict of interest and are doing something about it, right? I mean, because it's clearly, if you've got a third party advisor in a fund, you got that conflict of interest there, like you said, and it's just, and many times it's, it can lead to poor circumstances, especially for the people that are part of the BDC, right? So
yeah.
But yeah, no, it's interesting. I mean, the one thing that the guy Sam Haskell that came down yesterday and talked was this has been a growing part of the market and continues to be a growing part of the market. The bank loans have declined in terms of growth rates, and high yield market has actually gone flat to down. So this is where a lot of that stuff is migrating to. But again, I think the key thing is having a good underwriter and having someone that can sift through this stuff. I mean, I think it's generally true in banking too. There's 2 things you look for, I think, in good banks. Good underwriting, that's number one. You got to make sure that you understand the underwriting, the risk return. And the second one is efficiency or low cost, right? So the banks, I think, that do the best are the ones that are the most efficient and that have the best underwriting in traditional banking. And it's the same thing for BDCs. I mean, if you look at, like, say, Sixth Street, I mean, I think their expense ratio on an efficiency ratio basis, which is basically NIM, and you pull out what their expenses are, it's roughly around 37%. There are some more. There actually is an internally managed company where it's a lot lower. It's like in the mid-20s. That's Main Street. So Main Street has an internally managed sort of structure that's a little bit different from that perspective. But yeah, no, it's an interesting group of companies. And I think from a rate of return perspective and alternatives, it's something you always can say, okay, if this is my base of return at 18, I'm gonna try and look for some higher return on investments if I'm an equity manager. And the one of the areas I think that we've sort of have dug into a little bit, which is showing some interesting promise. And this is of course, there's the banking stuff, but then there's also other companies like car dealerships and other ones where you can get relatively high returns on equity. A number of these are sort of more can have some cyclical aspects to it, but there are some metrics I think out there to sort of try and offset that. I mean, the way that that one way to look at like car or just to call dealerships in general is they have two income streams, right? You're selling the initial product, which is more of a one-time sale, but then you have service and everything else, right? So
Yep.
you can look at, it's very interesting if you look at this across different types of sectors. So you start, let's say like a marine company, like One Marine, which is a big marine boat distributor. Huge amount. I mean, I think probably only 15 to 20% of their stuff is service and recurring. You go to the other end of the spectrum and you go to somebody like, let's say, like Rush Enterprises in the truck dealership business. The truck dealership business, it's maybe 70%, recurring and 30% new because you have a large installed base.
Yeah.
And so where I think there's some really interesting opportunities out there is where you can get these large installed bases where you're providing recurring service revenue to. And the nice thing about a lot of these things, which is interesting too, is a lot of these companies have a tendency to be privately held. So your competition is privately held. And the other interesting thing about like car dealerships is most OEMs won't approve private equity to buy these things. So what that really...
Why not?
Oh, they don't want to, they don't want them because what private equity does. I mean, if you're an OEM, let's say you're Ford or GM or something like that, you want your dealer to basically just to continue to do cars. I mean, if a private equity got some leverage on this thing and could cause you problems, then
yeah, not worth it.
Not worth it. So what it really creates is a very interesting situation in these dealership type businesses where you don't have private equity competition. So the multiples have a tendency to be relative, they're lower because you're not competing against these buyers. But what it creates is opportunity for guys that want to consolidate in this business because they can get decent dealerships and roll these things up and get effect. I mean, private equity would love this because this is exactly the kind of model they love. Like as you roll things up, you get local economies of scale and you can just roll it. And as it gets bigger, it gets better. All those sorts of nice things that happens with consolidation in the businesses that they like. But in this space, they really can't do it. So I think the beneficiaries of this are primarily the larger consolidators in this business. So you've got guys like, Asbury or Lithia in the auto business. You've got Rush. But again, in these, you still have tons of these private businesses that aren't public either. So, I mean, the other aspect about these businesses, even in things like, equipment dealer, is that these are kind of businesses where in a generation or two, a guy can make a good amount of fortune. I mean, a lot of these car dealer guys, they started out after World War II. They just got a dealership and they just built it, and it was not capital intensive, right? I mean, because you finance the cars from either the OEM or a bank. You have to invest into some of the equipment, but what's happening now is it's getting bigger. There's more requirements for that, but still, it's a really nice business. Like the free cash flow conversion of these businesses. Operational cash flow down to free cash flow is probably 80 to 90%. So they're really nice from a economic characteristic business. So those are the kind of situations I think that are interesting now. And what happens is I think a lot of them get lumped in with cyclical business. They're tied with cyclical pieces of equipment typically, or cyclical. They're tied with cyclical businesses, so they get tied in with that in terms of the way that they're valued. Even though if you look at the recurring revenue and the amount of that's increasing over time, I think they're not really reflected in the multiples. So for example, right now, if you take a look at a company like Asbury or Lithia, those guys are probably selling for 5 or 6 times earnings. They've got growth plans to get them 20-30% growth over the next 5 years.
It's interesting. I was just looking at the holder list. David Abrams owns both those, and then he also owns Camping World. Yes,
he's a very interesting guy. He's got yeah. I mean, there's one very interesting, and they also, from what I understand, they also own private car dealerships.
Oh yeah,
and camper dealerships. So they have a really view on both sides of the market. So, but yeah.
Yeah, I've got 7 4. Like I don't know. I think it's like 6 times. But yeah, that makes sense.
But what's happening right now is...
And then you got debt, right? But you're going to have debt. It's all floor plan, right? For the most part?
For the most part. And floor plan, in essence, I mean, doing business appraisals for 20 years, when we valued a car dealership, we value the interest expense as operating expense because it's not really truly interest of an operation. It's just part of your operating expenses. So what you do is you value the company, you say, okay, interest expense, you put it as an op expense, and you don't include it in your total debt. So these, like you're saying, for the most part, these companies don't have any debt because in essence, because you can always get floor plan debt usually at a reasonable rate. Now the rates have gone up a little bit, but typically you're getting because it's collateralized by the inventory of the cars, and either the OEM will provide it or you'll get some bank that can provide a relatively low interest rate on it. Even some credit unions do that kind of stuff now, which is interesting. But no, it's the business. I think the whole dealership business. I think is very interesting, and it's also interesting when you're involved in a business where a majority of the industry is not publicly traded, right? I don't think there's many industries out there that are like that, but dealerships, I think, is clearly one where, the biggest guys are there, but you still have, if you look at the list, they come up with the dealer list, the top 100 dealerships, you'll see the top guys, there's maybe 5 or 6 of them, but below that, it's all private. And you get these huge private companies that basically own dealership. They're basically dealerships, and I think it leads to a different dynamic. And it's and the same thing in other sort of areas too. I mean, when you're dealing with like cat dealers, which is another interesting, I think, area where you can get the same sort of effect. If you want to invest in the price of copper or any of these other metals going up, a cat dealership's a perfect way to do that, right?
You mean Caterpillar?
Caterpillar, yeah, because Caterpillar is the major OEM of the mining equipment, and actually the people pay a premium price for cat equipment because it lasts longer, and the whole maintenance aspect of it. It's really an interesting area from that perspective. So I mean, dealers, I think, is a real another sort of this capital light space, and you can make the returns on equity. If you take a look at like Asbury, it's what 30% range or something like that. And that's sort of been between 20 and 30 for a long period of time. So it just grows over time. So, I mean, they are good businesses, I think. And it's a question of, some people they see the cyclicality and they're not as interested as they would be.
Well, you're worried about the units, the asset turns right now, right? I mean, if we just got done with the Tesla call where Elon talked nonstop about how interest is creating higher payments for the cars and people buy payments. So I think people are maybe a little bit afraid to step in front of what they think could be some halting volumes.
Yeah, I mean, that's a key thing, right? I mean, because your return on equity is going to be a combination, or your return on invested capital is going to be a combination of turns and margin, right? And so, especially on the new car sales, which basically, since Tesla doesn't create service revenue, that's probably a majority of what their focus is, right? So they're looking at turns times margin. I mean, the nice thing about other car dealerships is in the dealership business, you have the service aspect, which can be a very large percentage of the gross profit, which is your sort of recurring revenue aspect of the car business, as opposed to the one-time sales aspect. And so it's an interesting business. And I think when I started out, like we talked about before, I was vested in like these radio stations make a lot of money, but they're sort of in the decline stage. Telecom, there used to be some growth stuff, but again, so telecom's really capital intensive. When I've gone back and take a look at, some of the previous stuff that I invested in on a return on capital basis, using things like return on invested incremental capital, the businesses, I don't think I would have looked at them today, because it's just like, you just look at it, you just say, okay, well, there may be some small times when things recover because it's in real decline, but I haven't really been able to find in telecom sort of a long recurring revenue kind of a compounding type of a situation, which is, I guess, what I've sort of migrated towards, trying to find businesses where stuff can compound over time internally in the business. And it becomes more of like a longer term sort of investment strategy, and the manager basically is a good steward of basically being able to keep the compounding machine going. I mean, the one thing that I found interesting, like one of our recent buys that we have bought in this company called North American Construction, what these guys do is they basically move dirt but they move dirt in supply constrained markets. And so what that does, if you look at it, is a return on equity is right now it's probably in the 20% range or something like that, but it's going to go up into the 30% range next year after an acquisition. And what's really happened with those types of businesses is they've increased their cash flow conversion over time. So the free cash flow conversion used to be, in a lot of these businesses, they're probably close to break even. But then these guys have increased the free cash flow conversion to, it's going to be like 45% after this acquisition. So you've got these businesses that are sort of transforming themselves, which I think is what really happens. And what people have a tendency to do is they'll value it the way the business was as opposed to the way the value it's going to be. And I think that's where there's some interesting opportunities.
So how do you move dirt in a supply constrained market? What's that look like?
Well, what
is a supply constrained market for dirt moving?
Well, a supply constrained market is where there's not too many people that can compete for a number of reasons. One has to do with personnel. So where most of these operations are up in northern Canada. So you've got a personnel issue. And then you also have a supply issue in the fact that the equipment itself that work in these sort of remote climates sometimes can get stuck. In other words, you're working in a region where the permafrost will basically melt during the summer. So you can get your equipment up there in the winter, but it's stuck up there. You can't get it back when the permafrost melts. So what that really creates is it creates a supply constraint where there's not too many construction companies, first of all, that can find people that want to go work in northern Canada in real cold places. Second of all, that want to deal with the issue of trying to deal with equipment and just the severe weather and the wear that it puts on equipment. And so what North American specifically does is they step back and they said, okay, well, what are the highest capital return items in our business? One is sort of course, finding the people, but the second one is the actual equipment themselves and maintaining it. So they internally maintain their equipment to have it last longer than, let's say, other guys that wouldn't necessarily do that. And so what they can do is by having equipment that lasts longer and having specific personnel that they can get, they get an advantage. And so they also try to find other situations. They also do stuff for closing of coal mines. So they actually do, like, there's 2 coal mines in the United States where they just provide all the operational support for the coal mine to end of life. And so if you're a coal miner, this mine's going to end, we just find somebody that'll do the whole thing. What they've done, which I think is what good management does, is they find, okay, here's our people and equipment. Where can we get the highest return on investment for this? And so that's what they've done. The other thing they've done up in Canada, you have to basically, to be competitive, these mining projects, you have to JV with the First Nations, which is equivalent to, the Indians here in the U.S., the native peoples here in the U.S. Therefore, they've got those partnerships, and that's another thing that reduces competition. But in a business like moving dirt, like you're saying, it's in some parts of the world it can be very commodity, and it is in most parts of the world. And so what happens is it becomes a commodity service, and a lot of people can do it, and so basically the price just gets negotiated down. But these guys have found locations, and they bought this company in Australia. The focus is trying to stay on locations where the competition isn't that great, and therefore they can get decent pricing, and they're willing to, if the price isn't good enough for them, they'll walk away, which in my mind is how you can create good margins in this business. But it's tough for other guys that maybe don't have the scale and that basically are competing in more competitive markets. The pricing differences can be huge. I've got a friend of mine that owns a construction business up in Thunder Bay in Ontario, and just for him, the construction, the work that he was doing, job differences can be 4 to 5 times in remote areas versus areas that are more competitive. So, and then when you're dealing with competitive situations, you'll have 4 or 5 guys competing, and in essence, everything's based on price, right? So your competition is based on price, not on you having the equipment, being there, and getting the job done. So if you can find situations where the competition isn't as much based on price, price is always going to be a factor, but where it becomes less price-based competition and more, I provide a good service for for, it's reliable and that kind of stuff. From that perspective, it's the same way down in Latin America too. I mean, if you look at like two of the big cat dealers down there's one called Finning, which is a Canadian company that does a lot of the mining stuff in Chile, Bolivia, and Argentina. There's another one called Ferry Corp, which does the stuff in Peru. Though again, those guys, they have the cat dealers, and each of them have said, okay, they've worked with their large customers, and large customers said, we want to outsource a good portion of our maintenance to you guys. So you set up these facilities in these locations, and we'll just, because for them it's just easier just to say, okay, we're just going to outsource the whole thing, and it's one less thing they have to worry about. So, and both of them have, and being allied to CAT is key, because CAT has the most reliable equipment. They'll get the right parts and all that other kind of stuff. It's a very interesting business. And I've talked with other investors, and even the guys said, well, what about CAT? CAT's pretty interesting. What's interesting about a lot of these mining services businesses is about 2/3 of their revenue is recurring service, and only 1/3 is new equipment. So in that situation, what you're really doing is you're servicing an installed base. And that can be a very profitable business. And
then I guess if you get some mining upside, then everybody spends on new equipment, and maybe you get an extra pop or something like that.
Exactly. So you've got a base of a business where you can get these businesses. Like, for example, there's Ferry Corp in Peru. You can buy the business for like 5 times free cash flow. So you're like, okay, well, I get this base business, I can get it 5 times free cash flow. And if for some reason copper goes up, you get even more, right? And it's just...
What's that business? Ferricorp?
Ferry Corp. FERREYCORP.
So what do they do with the excess cash? Are they returning it?
Yes. Well, their returns on equity are probably like in the high teens. And what they do is they return about half of it. So they've got about a 10% dividend yield. And then they reinvest the other half, where they build out these facilities and continue to support more and more of the mining in Peru. And so I think it's an interesting way to play some metals from that perspective. So it's between those types of companies and the companies like North American Construction, those I think are really interesting ways and places where you can look for, this 15 to 20% sort of return opportunities from a total return basis. The other areas that I found that are interesting is just like trying to find other ways to play, some resource type stuff. Those have been more challenging. I haven't necessarily unearthed a whole lot of anything there that sort of gives those types of returns today. I'm sure there's probably something out there. I just haven't dug enough at this point. But then the banks is the same way. If you look at, like, for example, one company I was looking at in the banking is East West Bank, a very big bank in California that services Chinese expat population. The company's got returns on equity, high teens numbers. The losses are very minimal. The losses, I think the losses are on the order of, let's see, so East West, the losses are on the order of about 0.2%. The criticized loans are closer to like 2%. So the way I try to take a look at banking is 1.7%. The way I try and look at banking is they have some new disclosures this past few years. You can take a look at the non-performing assets, which is one piece, but then they have these new things which are called sort of criticized loans, which are loans that are put on watch lists and all that other kind of stuff. So you can look at any bank and say, okay, here's sort of the watch list is sort of like the things that they think there's problems with these loans. But they think some of them still may perform. So look at East West Bank. So their criticized loans are at 1.7%, and their non-performing is 0.17%. And the thing's selling for, what is it, 6.5 or 7 times earnings, and it's got almost a 20% ROE. And if you look at the ROE over time,
but that ROE looks elevated, right? Well, let's call it 15.
Well, and what's it based on? 20% ROE, 15-20% ROE is based on a NIM of, call it like 3%. Okay, so if you look at, they're leveraged 10 to 1, 3% with low losses. It'll get you about. I think it gets you sustainable ROEs probably in the high teens, I would think. If you look at it over time, it's actually increased. So the other thing I've looked at is you do the return on invested capital over time, and sort of see what's happened over time as it's gotten bigger, as it gotten better. So that one, I think that's an interesting one. And the other interesting thing about the types of loans that they make, let's say versus some larger banks, is they have very little central business district exposure for their office stuff. So the office stuff is, more loan amounts and a lot of recourse. So now, one thing I've been trying to find, and I've asked other people out, no one's been able to provide, is what portion of their loans have recourse on it, because that makes a huge difference in my mind when it comes to commercial real estate. Because what happens is that if you've got no recourse, then your incentive is that when the price goes down, just to give it back to the bank, right?
Yes.
But if you've got recourse to something else, all of a sudden you're going to be like, okay, I'm going to try and pay this loan. It's really got to get bad if you got recourse, right? I mean, so. But yeah, I mean that's another one where basically, they said they're going to start to do buybacks. I mean, what that really says to me is they start to do buybacks is that maybe the growth isn't going to be super large, but I don't mind if growth's not large. If they can buy back stock at the price that, what's the price, 6 or 7 times earnings or something like that? Buying back stock,
it's below book.
If you're buying back stock at 6 or 7 times earnings, and that's your alternative, that means that your loans are making stuff above that, then. Because like you're saying, I mean, the question is, okay, will this thing revert? Well, it's going to revert if the NIMs get squeezed, right? And so that's what's really, a lot of banks that may have had good, let's call them customer franchises, have gotten squeezed because they don't have a deposit franchise, right? So that's really caused some issues with it. I mean, you have banks like Hingham who have a really good customer franchise in terms of giving people a loan, but they don't have a deposit franchise. So their NIMs have gotten squeezed. I think their NIMs are, it's close to like 1% or something like that. They used to be 3 to 4, and that's a tough one because if you're not, but East West has been able to keep it pretty steady. I mean, the other thing about East West, which I think is interesting, is Lai Lu's been buying a bunch of it over the past 6 months, and he looks for big.
You got the Munger seal of approval with that one.
Yeah. It just seems to be a lot of things that are. I mean, given his, exposure to China, I'm assuming there's probably he probably has some insights that are beyond what I can. I mean, because there's 2 banks in California that do this. There's East West, and there's another one called Preferred Bank. East West has a lot more, I would say, English, but East West is about 10 times the size of Preferred. But East West again sort of has they have a very balanced franchise. About a third of their loans is C&I, a third of it is residential, and a third of it is CRE. So it's a nice balance between the 3. Also,
they had a nice little insider cluster buy in May, almost at the bottom. Good job, insiders.
Yeah, that's right.
Interesting.
But yeah, they have really low efficiency. I mean, I think their efficiency ratio is in the 30s. So from that perspective, it's very well. I mean, they don't offer anything other than pretty much spread stuff, but they do it really efficiently, and they've had a really good underwriting. So I mean, in my mind, those are, I guess, the one sort of issue there that may prevent it from getting, I would say, necessarily a full valuation, is they do have a number of loans in China. They've got about $2 billion of their loan book of about $50 billion. $2 billion is in China. But a lot of that, I'd say a majority of that has to do with their trade, because they do a lot of trade stuff, trade facilitation. And so those loans are associated with that. So I guess if something happens bad with China, then these guys are going to have, there's that risk. If something happens with Taiwan or something, I guess that would be the potential risk here that they, I don't think they can do much about it. It's just sort of the way it is. But yeah, no, I mean, those are the areas that, I mean, today that I've seen. I mean, the stuff like the car dealership stuff, that sort of, that continues to be there. There's companies like Ash-T, which is sort of in the rental business, doing that type of stuff too. And I guess the scope of what I've looked at and the businesses that I've sort of have been evolving into have been more, I guess, service / recurring types of businesses from that perspective. So
yeah, that makes sense.
But yeah.
Asbury, I mean, the thing that's tough, and this is not unique to car dealers, right? But according to the DeLupa machine, if I look at like gross profit per new vehicle sold, I'll just start in 2017. You got $1,700, $1,600, $1,500, 23 in 2020, 45 in 2021, 56 in 2022. Like it's just tough to figure out where all this settles.
I think it's tough. You're right. I mean, but what's happened is they have acquired more luxury dealerships over time.
Yeah.
And I think what happens is the business, if you look at the guy that's a pure play that hasn't been doing a whole lot of acquisition lately, it's been AutoNation. So that gives you an idea of almost like a pure play is. But then you got the guys like Lithia and Asbury that are rolling up. And so they're buying other car dealerships.
Yeah, that makes sense. It looks like their gross profit per luxury vehicle sold has increased from $3,500 to almost $8,600. So, yeah.
So, and the luxury ones I think are maybe a little bit more sticky than the non-luxury ones, right? In terms of as long as you're providing good service, people are willing to pay for that. And those are the people that are willing to pay for a nice service. Versus, if you're dealing with more standard autos, as those are more the GM Fords and that kind of stuff. They're not quite the paying for the service. But again, the whole thing in car dealerships, and that's why Asbury continues to have the highest inventory turns in the business, and that's really a reflection of how fast can you match a car to an individual, to a customer, right? And so that's the core of the business in my mind is. If you can match cars to customers faster than your competitors, you're going to win because you can offer lower margins and still get higher ROEs than your competitor by doing that strategy, which is sort of like what Asbury's been doing is basically being able to do that matching action, I guess, quicker than everyone else. And they built a culture to basically do that. And they actually have, productivity measures internally from an employee perspective that they expect, so much revenue or other metrics associated with employees to increase productivity over time, and they've done that, and they're planning on doing that in the future. And I think that gives you another sense of the business is going to get more and more efficient over time in terms of delivering cars for a lower cost. And then you even have, if you're even dealing with the bigger sort of macro issues that could potentially happen if the car dealers go with the agency model, which is basically dealers, rather than buying the car themselves, they act as just an agent for the OEM. The bigger dealers, the consolidated ones, are going to have a huge advantage over the smaller dealerships then, right? Because it's just like the scale differences are just huge. And so, that would probably be the worst case for the dealers is they go to the agency model. But even if they go to the agency model, I think the guys like Asbury and Lithia and the larger ones are better equipped to take care of that than the smaller guys are.
Well, if you go to the agency model, you should. Then what? The OEM is carrying the assets, right? So you get the floor plan out of your business.
Yep.
Then you're just taking like a sales commission, right? But you keep the service revenue.
That's right.
Unless a lot of electric cars enter and the service revenue is a lot lower.
Well,
but we'll see if that's true.
Well, yeah. From the early indications, if you look at, there's a company called Bilia in Scandinavia that's done probably furthest along electric of anyone, and they're not seeing any decline in revenue per car for electric. And other guys, Auto One in the U.S. has done a study on that, and again found that there's really no, because I don't think people all of a sudden are going to get smarter and not going to say, okay, people aren't going to say I'm going to start to fix my car, right? It's just going to be, I think there'll always be a place for someone, given how complex the cars are, to basically have someone to help you out in terms of doing that stuff. And if you provide it in an efficient way and a helpful way to customers, I think it can be a win-win, and that's what these bigger guys are trying to do.
I guess the only risk would be if they are actually more reliable and you get fewer visits, right? If fewer things can break in an electric car, and I'm only saying this because I've seen what happens with golf carts, but like a gas golf cart has, I don't know, 3-4x the amount of moving parts that an electric cart has. Mm-hmm. So, just kind of how much stuff can break. If cars are similar, if fewer things break, you're going to have fewer visits. But that's interesting. Bilia is the place in Scandinavia?
It's a Swedish auto dealership. They're the furthest along because they're the furthest along in terms of electrification. But if you look at Bilia's annual presentation that they've got, they go through and they talk about service and what their thoughts are on service. And what they found that, yeah, I mean, it's not, I mean, initially, now again, this is initially, they're actually finding the service revenue goes up because people are having so many problems and issues with electric cars. But I mean, I'm assuming that that'll settle down eventually. But what happens with electric cars is the service is a little bit different, right? I mean, you're probably going to be dealing with battery issues. You're definitely going to be dealing with tires because you're going to need more tires because there's more torque on the wheels. And so,
and more weight in the car.
More weight in the car. And the other thing, too, is these cars are becoming like moving computers. So you have the whole computer aspect of the thing, too, right? And now most cars have some of that, but it just seems like that going forward, there's going to be more and more of that. Now, the other thing that's really going to help out the service aspect is sensors. Once you get the sensors in the car, and you talk about this autonomous driving, us driving with autonomous cars and having the sensor calibration issue is going to be huge, and that's going to be a huge boon for these companies, because they're not going to let you to get on the road if your sensors aren't calibrated. And I don't know if you've driven in a car that have a bunch of sensors in it or not. I mean, a lot of the newer ones do, but I've driven my dad's car, this was probably about 10 years ago. It was sort of a high-end Cadillac that had all these super sensors on it. And the problem is that when they get uncensored or something happens to them, it's just, I don't know. It just seems like that there could be a good service opportunity when it comes to the sensors aspect of things too. So, I mean, I think the service business is still going to be there. It's just a question. It's going to be servicing different things as opposed to what we service today, because like you're saying, there's not as many moving parts, but there's other things that I think people want cars to do that will create other opportunities for these service companies, if they're providing good service, to continue to have a good business.
Yeah.
Yeah,
it'll be an interesting thing to watch. I was listening to Elon's call today. They just dropped earnings last night, and it was a very interesting earnings call.
Yeah, I mean, the Elon thing is interesting because when you look at Tesla, how much do you think Tesla is sort of a one-off in terms of they have a specific customer base and demographic that are specifically willing to deal
I think he's coming for everyone, man.
Well, he's trying to come for everyone, but then how effective is that? It'll be interesting to see how effective that is, I guess, let's say. Because the people that I know that have Teslas are super tech enthusiasts and they love the stuff. It's just, and I think they're willing to put up with a lot of the stuff that other people may not be willing to put up with in terms of, I don't know. I mean, if you look at where their customers are, they're all located historically clustered in very metropolitan areas on the East and West Coast, right? And if they're all in those little clusters, then it becomes a lot easier to service and deal with them. But if they're all over the U.S., then all of a sudden it becomes a much more difficult issue to try to address. I mean, I'm not saying that they can't do it, but I just think that there's challenges.
Well, that's why he needs the robots.
Yeah.
And we'll see. I don't know, man. He's going to try to drive the price down as low as he possibly can. And the robots thing, I only say half joking. I have no idea how to assess the probability of it working. But it's going to be interesting.
Yes, it will be. Like I'm saying, I mean, he's definitely a pioneer and willing to go out on the edge, which is good to sort of see how things turn out here in the end. Because I mean, even though, let's say, even if less than half the stuff what he's talking about doesn't work out, it's still pushing the whole industry forward and making everything better, which I think is a win for everybody, right? So it's a lot of it in it.
Yeah, you need people. I mean, the world needs people like him in it. That doesn't mean I got to own the stock or have an opinion on it, for that matter, which I used to think I did, but now I no longer think I do. I think that's somewhat enlightened. I think saying I don't know more has been a net positive in my life.
Oh yeah, no, for me too. I mean, like I said, it really helps out a lot when you know what you don't know. that's a whole process in and of itself, is to try to establish, okay, I don't know about this, and let's just move on, and because there's a lot of other stuff that you can do that you do know enough about that you probably can make a difference in versus not. So
yeah, that's right. I'm just flipping through Asbury. Interesting. They it looks like they had more franchises, more luxury franchises back in 2013. And then they kind of like bottomed out in 2016, 17. Yeah, and then they've been adding starting in 2019.
Yeah,
Interesting.
Then they had a big Park Place, which was a luxury dealer in Texas, was a big one they made in 2019. And I think going forward, I mean they're buying one in DC now. I think that's a big Toyota dealer called Koons Automotive. But both the Japanese and the Korean dealerships, I think, have done really well here and just in other places around the world too. From a dealership perspective, I mean, we also own another company that owns a good-sized auto dealership in Greece, one of the bigger auto dealers in Greece, and they've done relatively well because they basically were not only do they own the dealership, but that they also own what are called auto distributorships, which are pretty nice, where the OEMs, they're direct distributors in most of the big markets, but in these smaller markets, they'll get somebody that basically, they just don't want to deal with all the different dealers in the country. They'll say, okay, we're going to have a dealership, and it can be a very nice business. There's a company in Europe called Inchcape that does a lot of that for these OEMs, but this company specifically in Greece, very entrepreneurial family. So they have this large distributorship, dealership, rental business. It's an interesting one. It started out as a rental business, and then the same family is the family that basically took over the Greek state airline, and turned it into Aegean Airlines and stuff like that. So it's a very entrepreneurial. And the nice thing about it, this is one of these kind of situations where, okay, the CEO pays himself less than other people in the company, the business, and I usually, those kind of situations are usually pretty interesting. I think when you find that kind of situation, you don't find that very often.
Yeah, that's right.
It's a family owned business, but he basically pays himself less than other people that are there in the business. And to me, that if you can find that in combination with good returns on equity, which I think this business has, and and they're very entrepreneurial, so they've gone out and they bought. They bought some of these Hertz franchises in different places. One day, I think this was probably before Russia invaded Crimea, they bought the Hertz franchise in Ukraine and stuff like that. They're really entrepreneurial in the way that they recently just bought a big business in Portugal. So the Hertz rental business in Portugal, which I think they've been able to, which I hope that they'll continue to sort of expand from that perspective. But they've done a really good job. I mean, that whole rental business is almost a business underneath a business, because the rental guys, if you're good at buying cars and selling cars, that's where you can make a good amount of money, because you buy the cars from the OEM at a discount, and then you sell them. And what they built out like all these used car locations in these different countries to sell the cars after they're done with them. And so it's interesting how that whole value chain. So that's how they work versus like someone like Sixt. Now, the way Sixt works is when they buy the car, they sign an agreement to sell the car before, at the same time they buy it, so they don't have any residual risk.
When you're thinking of going back to the paper that we started the conversation with, like where would you put these companies in their life cycle?
Well, I think
the acquirers, you would say that they're growing, right?
Yeah, I would say, I'd say they're growing, but some of them are sort of in the mature aspect also. So I think they're really growth, but by mature, I guess the way that they measure this is they say, okay, if the business is not, if it's based on cash flow from operations, right? So if it's cash flow from operations is positive, but cash flow from investing is negative, I guess, you could say the growth is, in their framework, that would be a growth company, because the way that they sort of characterize it, they say, if cash flow from operations is positive, but cash flow from investing is negative, it's in the growth stage. Cash flow from operations is positive, but cash flow from investing is actually, you subtract the two and you still have cash flow left over, then that's more in the mature stage. And so they have a very definite quantitative way to sort of measure this. So it's not really.
What do they put negative cash flow from operations x share-based comp? Where does that go? That's got to be growth.
It's got to be growth. Yeah, growth or
investing through the income statement, man.
Well, it's more.
2021 was great. That was fun.
It may actually be introduction if they've got negative cash flow. Well, yeah, that's the thing. Like you're saying, stock-based comp in a lot of these tech companies is just, if you pull out stock-based comp, a lot of times there's not much free cash flow left, right?
Yeah. I have mixed feelings on this whole thing. I still don't know exactly where I fall on it. I should probably figure it out and just be done thinking about it.
in regards to.
Well, I mean, look, you got to, I think having employees that have ownership stakes in businesses is a very good thing. The share-based comp, I think, it should probably be moved down to the financing activity, right? I mean, you're basically giving a portion, the minority shareholders are giving a portion of the equity to their employees, which is, fine. But I think it's more of a financing transaction than an operating cash flow issue. And then you get into this thing where, like, as the stock works, the number looks bigger because the like RSUs or whatever are worth more.
Mm-hmm.
But the problem is when the stock re-rates, I feel like you end up getting diluted at the bottom. So I don't know.
Well,
I
think the way that they've done it has probably been the more conservative way, which I guess is what you'd want for the accounts, right? Because when they're doing the RSUs and the calculation, they're using the current stock price. And if the stock price goes down, it may be overstated, but you really don't know at the time. I guess you're sort of trying to. It's an accounting thing it's tough to sort of manage. It would be nice, like you're saying, if there was a way you could just account for it as additional dilution for common shareholders versus the whole company. That would probably be the cleanest way to do it. But from an accounting perspective,
well, that's what I think certain people would argue, right?
Yeah.
Just argue the trued up cash flow and then hit the share count dilution. Right, just increase your denominator on the share count.
Mm-hmm.
Ignore whether or not like count the cash flow from stock-based comp, count that as an operating cash flow. So that is true cash. However, increase the share count to offset the, on a per share basis, I think is what people would argue.
Yeah. So you just add back stock-based comp in your free cash flow calculation, and then just say you've got more shares, and therefore you need to dilute the shares. But then I guess the question is, depending upon the time frame that you're holding it, you may get more dilution or less, right? And how does the market? It gets
well, and then the thing that sucks is when you look at a company that's buying back a bunch of shares, but the share count doesn't move, and that's in the financing transaction. Should that actually be an operating cash flow? Because it's kind of like offsetting the dilution. So you gotta, you can't have it every which way. You gotta be like if you are going to count the cash flow from operations as true operating cash flow, and you're going to increase your share count that you're dividing by, then I think you also have to look at the buybacks that offset dilution and almost jump that up to the operating cash flow.
Yep, because that's cash you're paying to basically offset the dilution.
Yeah, right. Like you gotta count for everything in this whole thing. Is kind of the wonky part. So I don't know, man. I mean, like I was talking to my guy who I rely on for a lot of my debt takes, and he's he's a smart guy, and I just I have conflicting opinions right now. I mean, the BDC, I have more a funnel of ideas that come in that I can process, which is my current cog that I need to figure out. But like between where I think high yield is and where, you're saying the BDCs are, I just have a hard time like getting super juiced up about like taking equity risk right now. And then, I get myself to say, well, that's if credit looks this good, equity's probably good, but I don't know, man. So high yield and some of the perhaps some of the BDCs is the best way to say it. Just kind of like feels like enough.
No.
And a reasonable part of the capital structure to play.
And so the things that'll get me really excited is if I can find something with, let's say, ROEs in the 20s, 30%, selling for a really cheap price, like some of these auto dealers and stuff like that, that'll get me excited. But if you
got to grow, though, I mean, that's the only issue.
Well, they're growing via acquisition, right? You can take a look.
Yeah,
their ROICs are still pretty good. That's a metric I've been really using lately, which is primarily You take a look at cash flow from operations, X working capital, look at the change in that. And then your investment is a combination of your acquisitions, your cash acquisitions plus stock paid for acquisitions, CapEx and buying of any intangibles or real estate or whatever. And sort of you get the changes in both of those, and that gives you an idea of, okay, is my ROIC going up or down, or which way is it really going over time? And if you find the businesses where that ROIC number that you're calculating is higher than the return on invested capital, then your number's migrating up. And that's a real positive aspect. And I think that's something that, if you take a look at that and if you take a look over time, what's happened with those businesses, those have really, and it probably goes back to sort of this paper thing, is if you're migrating from one of these lower growth areas to a higher growth area, you're gonna do well. I mean, I guess the challenge in some of those numbers from different people I've talked with is when you're dealing with like a big cyclical business. So if for example, I've done that calculation for Winnebago. So Winnebago is clearly a hugely cyclical business, right? And so the question is, okay, but what they've done, like what some of the auto dealers have done, is they've used acquisitions to basically, maybe dampen the volatility as much. And so the real question is, I think it's gonna be tougher for Winnebago than, let's say, some of these auto dealers, because the auto dealers, the white space to do acquisitions is just so huge that they can continue to do this acquisition thing for probably another 10, 15, 20 years. When in the end, you look back on it, you'll see these cyclical things, you'll say these acquisitions can just overwhelm any of the cyclicality that's going on in the business, which I think is what you've seen over the past 10 or 15 years. And I don't see why it can't continue. I mean, if you can find these businesses that have this ability to have a wide field and a wide range, and then you also have the trend in these auto dealerships of these guys that started a dealership after World War I, World War II, maybe trying to hand it on to their kids. Maybe their kids don't want it, and so they want to get some exit event. That whole sort of story sort of plays into, I think, some industries that make it very unique, like auto dealerships, where you have this huge fragmented base and people are consolidating that may be able to offset some of the cyclicality that you would normally see in the business. But yeah, it's...
What do they sell those for? Like 2-3 times earnings?
Well, no, they're selling them for, usually like 4 to 5 times. I mean,
so Asbury's buying it at 4 to 5, and then it's trading at 6 to 7 or something, and that's how that math.
And then what happens over time is what these guys are able to do is they're able to actually integrate some of their operations. So especially when it comes to the internet. So if you take a look at somebody like Asbury, okay, the 4 to 5 times may be, with a little bit of synergies, but maybe not. But they have that whole online aspect. So Asbury has an online platform that it can use that may not be available to the existing guy. You integrate it in there, and the online stuff. If you're within a region, let's say, online sales can be hugely accretive, right? Because you're not.
Yeah, sure enough.
Depending upon the way that you structure it. Now Asbury's focus is they want to basically sell cars that are within 20 to 30 miles of their dealerships. Okay. Because then you can get the recurring service. Okay. Yeah. Other guys have said, okay, I'm going to sell you a car that's 400 to 500 miles away from my dealership. And I'm just like, I mean, you can do that, but the value in a car customer is the recurring revenue you're getting from service. The one-time sales revenue, you can even make a little bit of loss on that if you can get a good service recurring revenue stream, right? And so different companies have different sort of approaches to things. And, Asbury, I think, has a tendency to be their acquisitions are a little bit more, I would say, they're not as aggressive as, let's say, Lithia is. Lithia is more aggressive in terms of increasing by acquisition. And they bought a number of car dealerships in the UK, which my observation is the UK is where you go if you're a car dealership to die. It's an incredible market. I've never seen before differences in returns on capital and margins in the same business in 2 different countries being totally different. I mean, there's a company in the UK called Motorpoint.
Yeah, I was looking at Motorpoint stock.
Awesome business.
Thing has been destroyed.
Yeah, but you look at the economics have just sort of fallen apart, right? I mean, because they used to have really good margins, and now the economics and then you read their forecast, and you're just like, what happened to this thing? Well, the only thing I
mean, how much of that is like a temporary... my understanding of that business is it's more sales and less service, correct?
Mm-hmm. Yep.
and you've got like a real potential affordability issue in the UK in general right now, right?
Well, I think the biggest thing, just like in the UK and everywhere else, is really supply, right? Especially since they're selling these slightly used cars. You've had this period of time when supply from COVID's been shrunk. And I think their issue, just like CarMax, these other ones, is just their models work really well. If your car park is getting bigger and bigger and bigger and bigger and you can do well, but the car park's getting smaller and smaller, it stays relatively small, I don't think their models work quite as well when you have a smaller car park and you're paying more for the cars. And it's something I think that no one anticipated, right? I mean, who would have thought that in 2019, the car park would shrink because COVID shut down the plants for so long and there would be shortages of cars, right? I mean, no one thought that in 2019. And so,
yeah, might be looking at it again.
Yeah, with the UAW strike, yeah, I mean, you very, very well could be looking at shortages. Now, what the big three have done, though, is the big three have overproduced in anticipation of this. Well, I mean, because if you take a look at the days inventory of the big three auto, and they were pulling the stuff where, I mean, because the GM, Ford, Stellantis days inventory were just huge before the strike. So I think they sort of were cranking up the inventory in anticipation of this. Depending on how long it lasts, it may or may not have an interesting effect on that. But I just, that's the thing, because that surprised me about the UK market, because everyone in that market just is, the margins are it's just incredibly low. And you compare it to even guys like Bilia. Bilia makes really good margins in Scandinavia. The car companies here make really good margins here. I mean, there's other aspects in the UK that are a little bit different in that the OEMs can directly compete against the car dealerships, so they don't have an exclusive.
It's not ideal.
Yeah, and I think that there's just a large demand for a number of cars in the UK. It's just, I think the car per population is still relatively high there, but then you also have people in the UK, I think, doing the car business on the side of something else too. It's a little bit of a different market, and you've got.
But everybody's just getting in the car business over there. It's super competitive.
Exactly,
you got car business side hustles, sweaty startups starting one.
It's just like, okay, if that's
tweeting about it.
Yeah, so I mean, from that perspective, I mean, it's like I said, I've looked at car dealerships in Japan. I know there's some good car dealerships in Japan. They can make decent amounts of money. I've looked at them in Bilia makes a decent amount of money. But for whatever reason, the UK market just, I don't know what it is. It's unusual just in terms of businesses in different countries having such different economics. Is just, but I mean, that's sort of the way it is. And initially we were invested in a company that's called Cambria. Now, Cambria was probably the best dealer in the UK, but then management decided to take it under. And so basically, I mean, I think they're still probably doing well on a relative basis, but it's one of those kind of things where it's like, it's I don't know. It's I've never seen in looking at different industries such a stark difference between the two. Now Lithia's probably bought the best company. Jardine had this I think it was the luxury dealer over there, and now they're in the process. I think they're going to process of trying to bid for Pendragon, which is another dealership that's sort of in play over there. But yeah, and then AutoNation jumped in, which was sort of interesting because AutoNation, I think I've heard that AutoNation is going to start to buy dealerships again, because if you look at what AutoNation's done over the past 5 to 10 years, is they bought back tons of stock and haven't done much acquisitions. And it looks like they may be getting back into the acquisition sort of marketplace.
Not sure that's good or bad, but time will tell, right?
That's right.
Depends what they pay.
I mean, it's interesting because if you compare the returns between the various strategies, if you look at like the 10 or 15 year return of, let's say, AutoNation versus Asbury versus Lithia, AutoNation has underperformed both of them. But they've been able to get, both Asbury and Lithia have been able to get dealerships at decent prices.
Yeah.
But now, I mean, because with COVID stuff sort of totally, to a certain extent, gone upside down, and it'll be interesting to see how the thing all plays out with the increasing interest rates, because you had mentioned that's going to put a constraint on new car sales for sure, and even used car sales. So, it's what kind of stuff, and we're starting to see incentives. So, I mean, I think at least that's a sign that at least from commercials and stuff like that, so that's a sign at least that the shortage is not quite as quite as
Wow,
dire.
dude, you're gonna have to. If you don't have incentives coming out on any consumer, I mean, this is hyperbolic, but whatever. It's a podcast. But I mean, on like every consumer, what's a big purchase word that I'm looking for? I mean, they're highly discretionary durables, right? I mean, come on, and then you layer on the increase in interest rates, like, whew, man, that payment moved on people. Yeah, that was one of the things that Elon was talking about. Have you listened to that call?
No, I haven't. I probably should.
Check it out. Just like turn it on. I think you'd be interested in it. You know, he was just talking about like his whole goal is just to drive the cost of these cars down, at least how I understand it. And, you know, he's just talking about like all the progress that he has made, the tick up in interest rates have undone. Yeah. Right, because you're buying a payment, you're not buying like whatever the car costs, and he just can't outrun the interest rates right now.
Yeah, that's especially, I think that's especially true on the, on the lower end of the market. Some higher people can pay for cash, but that's probably a very small minority even there.
Well, that's what he went into. He was like, you may not understand this if you're making $200,000 a year, but like if you're making $70,000 a year, and I'm telling you, man, at least my perception from what I've started to follow is like he's coming for the world. Now, whether or not he can do it, I'm reminded of the whole Buffett thing. I forget when he said it. He said it a lot, but betting on change usually takes a whole lot longer than people like to model and or think.
Yep.
So, it's going to be very, very difficult to accomplish, but it's interesting.
Well, yeah. I mean, at least setting up the goal. And I think in the end, even if he doesn't if he achieves half the goals he's talking about, it's probably going to move everybody forward. Right? I mean, that's the beauty of the competitive system that we have, is that he'll do some innovation, some other people basically try to match it or do more of it. I mean, it's interesting because I don't know if you've ever listened to. There's actually a guy that, if you're into auto dealership, he actually has a podcast called The Auto Dealership Guy.
Oh yeah.
Yeah, so he
kind of know that guy.
He gets into specific. He has really good interviews with different people across the auto dealership value chain, and he does a really good job of just laying all that stuff out, and a lot of the things like you're saying of the financing and the interviews. He's actually a used car dealer, an independent used car dealer, which has got to be a really tough situation to be in these days.
Yeah, I have a buddy that's in it. Pinged him about credit acceptance. He said they pay well. Just as far as the refunds go, these are very interesting businesses, the dealers. So what got you into this? Like, why'd you pick dealers?
Well, I was just looking, I said, okay, where in the value chain, who's making the money in the value chain of autos and these big types of equipment? And the guys that have made money, or at least recurring revenue types of businesses, are dealers and service people, right? I mean, because the OEMs are spending a lot of money, and they have a tendency to be really cyclical, and there's a lot of competition and that kind of stuff, and they always seem to have, challenges in terms of creating steady profitability. But the dealers, across all different types of equipment and let's say even RVs or boats, I mean, you get some more recurring, but still, I mean, I think for the ones that one key thing I like to look at is what portion of the revenue comes from recurring versus non-recurring sources, and that makes a huge difference in terms of, at least for me, the favorability. Because what I think really interests me is that most analysts and most people looking at this throw the car dealers in with the OEMs, right? And if they same thing with the RVs, they'll throw the RV company, the RV dealer in with the RVs, and they'll throw the truck dealer in with the truck OEMs. And you're just like, okay, there's a clear difference in economics of these businesses. These businesses seem to be making more return on equity, but the pricing just doesn't seem to be reflective of that difference. And some businesses get hugely rewarded for having recurring revenue, right? Software, for example. Software gets hugely rewarded for having all this recurring revenue. But you look at these dealer businesses, and they're not getting much premium. I mean, the auto dealers aren't getting much premium for having all this service revenue, right? I mean, and the Same thing with other the heavy equipment, like the cat dealers don't get a whole lot of credit for having. I mean, there are some exceptions. I mean, in the cat dealer business, there's a company called Tormont it's in Eastern Canada that has a pretty decent multiple. They're like mid-20s multiple. There's another company in Australia that's called Mater Corp that basically provides service. They're in the mid-20s, but everybody else in the business gets nowhere near. I mean, their multiples are 5 to the highest, maybe like 13 times free cash flow. But they have these huge amounts of recurring revenue, but it's not reflected in the valuations. And I think that's really an opportunity. And I also think markets are really interesting when you've got the private market is bigger than the public market for these things. Because, most businesses aren't that way. Usually, right, the big guys are usually public and the smaller guys are private. In this case, you've got sort of a large private marketplace, which if you're in consolidation mode is a really nice runway for you to generate good returns over time, I think.
Yeah. That's what I've toyed with Camping World. You and I have talked about this, and then I looked at Winnebago and Thor and whatnot. And I guess that, like, the thing that I like about the idea of Camping World is I've done a fair amount of driving throughout the US, and it's a very visible, if you just keep your eyes open, you can see what's going on with the size of their lots and kind of, what I think they do. And I've kind of kept my eyes open for other how many other RVs have service bays. And I think there's a reasonable amount of truth to the story that is told by Camping World. And I think that there's probably a pretty good runway of acquisitions. What I can't figure out is how the hell are you going to sell an RV now?
It's tough.
And who wants it that hasn't bought one? That is really hard for me. And maybe I just need to suck it up. But it's one of those, I mean, I just hear Buffett saying, put it in the too hard pile until it's no longer too hard.
Yeah, they did get what they did get from Camping World is they did get a younger generation or demographic buying a lot of campers, where historically their demographic were people that were close to retirement or retirement type people. They did have that large younger demographic, and that may create some aspect of it. I mean, I don't know how long these things typically last and what the renewal aspect of it, but some of these businesses, I was looking at, like Winnebago, they own this one company where you buy these it's high-end mobile homes, and these things are like, I don't know, $300,000-$400,000 or something like that. And you're just like, I mean, here in Rochester you can buy a house for that. People pay for a mobile home. It's like, okay.
Yeah,
but it's all decked out. It's got everything you'd ever want, but still it's
you ever look at legacy housing? I think LEGH.
I've looked at those. I mean, those are very interesting businesses. I mean, I taught when I was at Berkshire.
This is all stuff Buffett owns.
Yeah. Well, I mean,
right? Like, you kind of, if you dig a little, you're like, oh, I can see. I mean, the crazy thing about Winnebago and Thor and them is, like, they're all in one city in Indiana. They probably all go to dinner together and collude on price. I know you're not supposed to say that out loud, but but like they live down the street. They've got to go to the same golf club or whatever they do there. Like, they definitely know each other.
Oh yeah, no, like I'm saying, there's Thor there, all the parts suppliers are there, and that kind of stuff. I mean, of the RV guys, I mean, I like Winnebago the best, just because of they seem to have tactically. A new CEO came in, and they seem to have they've strategically picked certain markets that they want to get into. Like they bought a towables company, which was big, and then they bought the luxury company. And then now they're getting into doing stuff.
They buy that boat company too, didn't they?
Boat company, yeah. And a lot of the thing with the boat companies, apparently there's common parts between boats and RVs and manufactured housing. Oh yeah. I mean, a lot of the parts manufacturers, they provide parts for all three. It's an interesting sort of business from that perspective. I mean, because I talked with one of the guys at when I was at Berkshire, one of the Clayton Home guys there, one of the sales guys that was there, and he said he thinks the business has this huge runway, and he's getting his kids and his grandkids involved in the business. He said this thing's just going to keep on going. He said what's really constrained a lot of the business historically, which he thinks is going to get fixed, is zoning. He said zoning from a manufactured home perspective. And a lot of these guys also provide parts for manufactured home. I mean, a lot of the stuff's very similar. They have factories, they build the stuff in there. It's, but yeah, so he was really bullish about basically, the whole business is a growing business. And, I think from an affordability perspective, I think that makes a lot of sense, in terms of that. But it's a real interesting area, I guess, and my hesitancy behind it has always been the cyclicality and not being able to sort of capture what that is. And I didn't see quite the same thing. I mean, in the car dealerships, you can see them buying these dealerships from these private companies as sort of offsetting some of the cyclicality. I didn't see a similar type of a situation in RVs and in let's say manufactured homes and stuff like that. So
Yeah, well, I don't think you're going to offset your cyclicality in RVs by buying a pontoon boat company,
yeah,
right?
that's true.
But
Maybe just add
I mean,
maybe a little bit different, but you're still,
kind of feels the same. I know it's different, but I mean, yeah, Winnebago. I guess they just reported, did they? Yeah, on the 18th, which was what, yesterday.
Mhm.
So it's just interesting. I mean, revenues in the 3 months ended August 26th. Revenues from 1.2 billion to 780 million. Gross profit from 210 million to 128. I mean, you give up 400 and I mean, they had some profit compression. See what year over year the gross profit was better than, didn't quite get caught in half. They're just, it's interesting because I mean, this is, the EPS is down almost in half, right? So to your point on cyclicality, but can't wait for it to bottom to buy it. I know better than that, but also, I mean, the numbers, not so much the stock.
Well, I mean, I think if you look at it over the longer term, that their returns on capital have also increased pretty good too. I mean, that's the other thing, and I think a lot of it really, they brought in a new CEO in 2016. And you can see the effect he's had on the business. I mean, that's interesting when you see a major guy come in. So in 2016, the new guy came in. Now we're going through a cyclical low now, but if you look at what's happened in terms of their incremental return on capital over the past 5 years, it's about 50%. I mean, part of that is COVID, but even when he took over before COVID, the returns on incremental capital were still like, 15 to 20%. So, from that perspective, I think it's, I mean, I think like you're saying, I mean, the big issue with these big consumer types of things is, so much of and that's one thing. If you look at like Camping World, again, their mix of recurring versus non-recurring is nowhere near the same as auto dealers and truck dealers and stuff like that. So that leads to that's going to lead to some volatility in terms of their mix, their sales mix from that perspective. It's tough because it's I guess the real thing for guys like Winnebago is, do you think there's going to be a continued increase in demand for their products, or do you think they've maxed it out at this point, right?
Yeah, and I can kind of get myself to buy that there's a secular growth story there. Mm-hmm. I mean, I what confidence interval would I put on that? I don't know, but you've got a graying population that is going into retirement. I think that, like, it's not unfathomable to me that population finds enjoyment going in a Winnebago. The incremental person goes on the road and maybe decides that camping is much more pleasant than spending God only knows what in a hotel that no longer really serves you.
Yep.
And then I think COVID, like, one of the things that I do think it highlighted is, how much happier people are outside. So I can, look, I think habits revert back to how they were prior to COVID more often than not, but I also think some stick. I think I've hedged my answer enough to give a non-answer.
No,
which is my entire job.
I mean, I knew someone who basically, she and her husband, basically when COVID happened, they just got in an RV and traveled around the country. And what's neat about a good number of jobs is you can do them on the road, right? You don't have to do it from a location. I mean, and the other thing too is I've noticed, I noticed with my kids and a lot of the younger crowd is, I mean, they like to go camping, but I think they like to have a little bit more luxury than the I guess.
Yeah, they want to the glamour camp.
Yeah, versus like when I was growing up and went camping and you go do it in a tent. I don't know how many people really want to go tent camping anymore. I mean, it was interesting when I was growing up, but that was sort of like what my dad did, so I ended up doing it too. But getting rained on in a cold rain is not a very fun experience with a tent. If you got a bunch of sleeping bags and the rain comes through, everything gets wet, and it's just like if you're in a camper, then you don't have to worry about those types of things. You still can have an enjoyable time even if it's raining and not so great. But yeah, no,
I'm looking forward to the kids and I camp outside sometimes, and I have this massive tent that we throw up, and that thing's pretty cool.
Oh, okay, great.
But it's getting cool enough that I can do that again. But that's about all that we do. And to your point, I'm not sitting outside, cooking Spam over an open fire.
Well,
I don't know. The asset turns are just the issue right now with right when you look at Winnebago. I mean, their asset turns are down from 2.2 times in 2022 to 1.4 last year. That hurts the old DuPont analysis.
Oh, it definitely does. I mean, the one thing that I think that is really good about the RV business, though, is you have rational competitors now, right? You got Forest River, the Berkshires, you're definitely going to be rational. Thor's going to be rational. Winnebago is sort of an interesting one. I think they do, from my understanding, Winnebago does a lot more of their design and manufacturing in house. So they do a lot more, they do a lot less of buying other people's parts. So they can make unique types of take advantage of that. So versus like the Forest Rivers because I think Forest Rivers headquartered in Elkhart, Indiana, I think, where they have all these.
Yeah, that's right. Yeah.
So Forest River there's Thor's there, Patrick's there, who's the big, and there's another one, LCI, I think is the other big parts guy. But Winnebago, I think, is like in Minnesota or in Iowa or something like that. So they're, they have some aspect of it, but I think they're a little bit more, they have a tendency to be more customized and do a lot more stuff, I think, internally versus outsourcing it, which is, an interesting differentiation point from a business perspective. But
I have a real bias towards the Midwest and like Minnesota too. Like if you're from Minnesota, I don't know. I just think you deal with such pain all the time in the form of weather that you're unlikely to be a rude or mean person. But maybe I'm wrong. Maybe that's a totally flawed way to think. But I have not met many Minnesotans or whatever they're called that I don't like, and that goes for the whole Midwest.
Oh yeah, there's the Midwest nice, right? I mean, that's the whole thing. It's just like, I mean, I grew up in Rochester, New York here, and it's probably more like the Midwest and the East Coast. But yeah, I mean, we get crappy weather here. It's just like we get over 100 inches of snow a year. It's just like
yeah, that's a lot.
You're just like, man, after a while, I mean, you're just like, okay, it's nice for Christmas and it's nice maybe for a week after that, but then it just sort of starts to get on you. But it's just, I mean, you can go out and you try and do stuff, but a lot of people from here have moved down where you're down there in Florida now. So I know my dad just moved down there, and now he's down there full time. But yeah, it's just like, I think people after a while, they just sort of. Now you're originally from what, Chicago then, or is that where you were?
Well, I grew up in South Florida, and then I went to Chicago. But, as long as we figure out our insurance situation down here, I think Florida is a pretty good structural long. But that is a big as long as, because right now it's a real issue.
Yeah, well, that's what I heard. I was talking, this financials guy in yesterday, and he was saying, like, apparently homeowners insurance for like some of these condos and stuff have gone up like 300% or something like that.
Dude, it's crazy. It's crazy. I mean, the issue that you've gotten hit with is as I understand it, a combination of rate has gone up and then the base, right? So not only has rate gone up, but also the replacement cost and market value has gone up also.
Oh, okay. Yeah.
So people are just getting hit with a double whammy at once. And, that... We have a fair amount of retirees in Florida. I don't know if you know that. And when they're dealing with a fixed asset base and they're living off income, and all of a sudden something as essential as home insurance increases that much, that can chew into people's planning in a real way.
Yeah, no, it's saying. I mean, that's definitely a challenge, and I know there's a number. I think it's even gotten to the point where I think a number of people have sort of pulled out of the market down there, right? So it's.
Oh yeah.
I mean, and if you got the insurance companies pulling out, that's not good for competition, right? It's sort of, really.
Yeah, and you've got a number of people that are just saying I'm going X wind, which you can do if you don't have a note on your property. But it's I don't know, man. We'll see.
Well, yeah, I mean,
it's a lot of risk.
Yeah, I mean, if your house gets blown down and you don't have wind insurance, what are you going to do, right? I mean, do you have enough money to rebuild your whole house? You've sort of taken on that risk, and it's like in Florida, you never can tell because I mean, this year's I guess been really good in terms of not, I guess there was one hurricane that went through there. I don't know if that hit you at all or not. With it earlier,
that thing hit the perfect spot of Florida, man. There was nothing where it hit,
okay.
literally nothing.
Okay.
But yeah, no, I watch all the time. I am a frequent visitor of the National Hurricane Center website.
Yeah, that's
so I don't know. Tammy's down here, but she doesn't like Florida. It doesn't looks like she's going to South America.
Oh, okay.
So
well, I mean,
hopefully we're done with it.
Yeah, no, I mean, I guess the only guys that are making out well with that are some of the insurance companies seem to be doing pretty well. If a hurricane doesn't hit, I guess, right? That's
yeah. I mean, yeah, we'll see how long the insurance market stays hard. Have you ever looked at Arch Capital?
I haven't. I mean, I've looked at Fairfax and Berkshire and then those other types of businesses.
Check out Arch.
Arch, okay.
Yeah, you might like that. And then what's the other one? The ticker's RLI.
Oh yeah, was it Reliance or not Reliance?
I think it might be Reliance.
Is it Reliance? Okay.
My buddy says that he likes that setup because it's like a big employer in a small town, right? So like when you have that kind of a dynamic, I don't know, maybe it's just called RLI. When you have that dynamic there, it's an incentive where you're not taking silly risk because the town becomes unemployed.
Okay.
If the company goes under, and I thought that was kind of an interesting take. Did I bring up what's the other ticker that I was somebody told me man, what's it? United Wholesale Mortgage. That's kind of an interesting company that you may want to put on your radar. The guy that owns it owns the Suns. I guess one of the potential issues is he may be borrowed against his stock to buy the Phoenix Suns, which could create some interesting path, not dependency necessarily, but you kind of wonder if you don't get margin called at exactly the wrong time.
Well, that's true. Yeah, because they also used the stock as collateral for a loan to buy the Suns.
Best I know.
Okay.
Best I know. So
it's United Wholesale. Yeah.
Yeah, but I think you might like that.
Yeah, I'll take a look.
So there you go. That's 3 research projects that I wish I could do. But I got a stack of stuff that I need to get through.
I know. Well, what kind of stuff are you finding interesting now? How do you prioritize? I mean, for me, historically, right now, it's sort of been, okay, if I can't make this certain amount of return, I just sort of put it off to the side, I guess.
Yeah, my answer is not well, and I'm trying to figure out how much I need to outsource. I mean, I don't spend nearly the time that I need to digging into ideas because I have spent much more time on the pod.
Mm-hmm.
And I don't think it's been a misallocation of time or capital yet, but I got to figure out, I mean, I've been talking about figuring out what's going on with this thing for a while, but I got to figure out what's going to happen with it. Otherwise, maybe the answer is if I don't figure out a way to monetize it or whatever, maybe I just back off the cadence and then, work more on ideas, or maybe I try to hire somebody to help me sift through some of this stuff. But, it's a fire hose of stuff coming at me, which is, I think, made me smarter on average, but working through the fire hose has been something that I could use improvement on.
Yeah, it's tough. I mean, for me, I think what I've tried to do is I've tried to get to quickly as I can what kind of total return can this thing generate, and then if it's not above 12 to 13%, it's just move on. I don't know if it's up, because I mean, so let's say I got some ideas from another guy that basically says, here's some good ideas. And if I look through it and I take a look at return on equity and that kind of stuff and say, okay, what do I think this business can grow as a combination of both growth and dividends? if I can't get to 15% plus, it's like, okay, let me just move on to something to see if I can find that.
Yeah.
But it's tough. I mean, and the whole thing may change. Like you're saying, if interest rates go back down to where they were before, then all of a sudden these things become, viable options from that perspective. But yeah,
Depends what happens with the rest of the world,
yeah.
Like it's just nothing happens in a vacuum, and I don't know. I'm grateful. I could have done a lot of things differently in 2020, 2021, 2022. I guess I wish that I had punched out at the top. I don't know anyone that doesn't. That was super fun. That's one of my lessons is tops are very fun.
Yeah.
But that and the hangover is not that bad. So it's all about making sure that the next decisions are the right ones and just moving on,
Yeah, and a lot of it depends upon what your specific needs are at that time of life too, right? I mean, if you're probably in a time of life where you got younger kids, so there's a lot of investment there from that perspective and other stuff going on. So it's not like, when your kids are gone and gone through college and all that expense is done, then you have a little bit of a different cash need from that perspective too, and that sort of drives a little bit of what you're doing also. So
yeah, there's also this element of like responsibility when the kids are involved and my wife's involved, that like now if I'm spending time on the podcast, I just have to be really honest with how much time I'm spending on the portfolio.
yeah.
And I think that there's I think this notion of like the less you think about your portfolio, the better it'll be, I think is both extremely flawed and actually kind of smart at the same time.
Yep.
So I don't know how to thread these needles, man. I have a lot of non-answer answers.
Well, it's tough because like you're saying, I mean, and then if you have made a few decisions, when you sit back and look at, okay, how much of it is, there's a certain aspect of luck in all this, right? And how do you disintermediate the luck versus, okay, this seemed to work out for this reason. I don't know. It's a difficult thing. I think when I was at your stage in terms of kids, I spent a lot more time just doing stuff with the family and really didn't get into a lot of this investing stuff until after. And it's just like, okay, the kids were grown and that kind of stuff. But it's like you're saying, it's a tough balance to sort of try to balance it out of what do you want to, I mean, it's your priorities from that perspective. And it's definitely a challenge. I mean, it sounds like it's great. It sounds like the podcast has gotten you exposure to a lot of different investment ideas and investment personalities.
Well, it's how you and I met.
Yeah, exactly.
I mean, I guess that's not 100% true. Manual of Ideas has been a big part of how I met a lot of people, but this has been really meaningful, and I think it stretched my mind and hopefully the listener's mind in a lot of ways. So, I really enjoy it. It's just a matter of keeping it going and whatever.
Well, you have to figure out the pace that makes sense for you, right? I mean, probably want this thing to continue on, and different times of your life you'll have different paces where sometimes it'll be more intense and sometimes it won't be. It's just
yeah.
I mean,
well, and then there's this element of like I have one guest that's coming on that's like very real.
mm-hmm.
Not that I mean, everyone is real at this point, but like if I'm reaching out to CEOs and I'm saying I'd like to have you on, I like to have a quality of audio product behind what I'm delivering
mm-hmm.
that they can trust.
Yep.
And that usually involves a certain cost structure that, kind of like, I don't know, it doesn't put like a drain on my life, but I think it nags at like a part of me. So I just need to get it to kind of like break even or run in itself. And then I think some of the negative mental stuff that goes along with, I don't know, some of my dumb associations will take care of themselves.
Mm-hmm. Yeah.
So, but it takes work. It doesn't just happen on its own, right?
No, it doesn't. But I think, like you're saying, if you can get you get a snowball starting to go downhill, and just sort of go down as far as it can go, and just enjoy the ride while you're on it, right? I mean, that's.
Yeah.
I mean,
well, it's like my buddy Alex is like, you got to write. And I don't think he's wrong. I think writing is a great way to monetize, but I kind of think of myself as an audio brand. So I don't know if it's like more podcasts behind a paywall. I'm just trying to work it out. But.
Well, I mean, I think your strength, Bill, is basically being honest. And I think I see that as coming out more in the audio and the visual, it's tough to, I think, get that same level of authenticity in the stuff that you do via the written word. I mean, I'm sure there are some
I think
people
that's
who do
true.
it makes it, at least for me, it would be much more difficult. I'm sure there's guys that can do it, but I know I'm not that skilled at writing, and it's a different you know, being able to show, I guess, authenticity and the sort of the brand that you are is, I think it's difficult to, I would find it to be difficult to sort of get a hold of it in a medium other than, you know, audio or visual. I don't know. That's just me, but
No, that's mostly my take as well. So we'll see. Whatever. I don't know. How's everything going with the fund? I know that you were like not at a crossroads, but it sounds like you're very happy with where you're at as an investor now.
oh yeah, no. I mean, it's really, I'm happy with that. I mean, I'm improving, learning new things, digging into different areas, which I think is sort of like what I want to do. I've got developed a group of other sort of investors that I talk with periodically and stuff like that. And so, I mean, I think that's what my goal is. It's basically just trying to, you know, enhance my ability as an investor, being able to realize, you know, where are some interesting opportunities, trying to filter out a lot of the, 'cause like you're saying, in this business, it's just a huge fire hose. And how do you filter out what you want to spend time on or not, right? It's a question of abundance. It's not scarcity. Maybe it used to be scarcity when you couldn't get access to a lot of these things, but now it's just like you have this huge fire hose and you need to basically try to focus on the things that make the most sense. And so, I mean, I guess from my perspective, I think it's just trying to look at businesses and try to find things in places where people may not necessarily expect it. And I think that's where the opportunities are. Like we talked about the car dealerships, this company, North American Construction, which is a company that moves dirt but can make 30-40% ROEs. I mean, it's those types of situations where you just say, okay, well, what's really going on here? And trying to find those, you know, sort of understanding what the dynamics are behind it, and then the question is what's the durability of it, and how long is it going to last, and is it cyclical, and just, you know, being able to do that. But then also just, you know, in my mind, I think that's what my goal is I want to basically be able to find those kind of businesses that I can say, okay, you know, I can invest in for 10, 15 years and not as and be focused more on, again, I think reading a lot of this stuff has put the bigger picture in perspective of where do I want to focus my efforts. And what this paper in particular, which has been more of a reflection of where I want to try and really get towards more, is saying, okay, I want to find businesses that are growing or that maybe are moving in the direction of growth. And I've seen in the past where I've done well, and sometimes I've overstayed staying in these flat to declining industries, and that's where I haven't done as well. And so my focus really needs to be on understanding, do the businesses have growth, and is the growth, is it sustainable, and will it continue to move and compound the way that I like to see it, and finding it in places that people don't expect it. I mean, there are a number of really nice businesses out there, but they have a tendency to be really priced relatively high in the marketplaces. And I mean, I guess there's a number of people that have done well just investing in those businesses over time and just letting the compounding happen. But I guess my internal makeup is more always trying to find something that's worth more than what it's trading for, and trying to find a framework to think about that in. And so, I mean, I think looking at like financials, which is an area that there's probably not a whole lot of growth investors looking in, and also in some of the natural resource things and some of these other sort of, you know, car dealers and these capital light types of things, I think are interesting ways to try and do that over time. I mean, I've seen some people do stuff successfully where they're actually able to, you know, invest in specific individuals and seeing, okay, the business may not be good, but you're really investing in the individual and time. That's another way to try and do it. That requires, I think, a different level of due diligence and understanding of the people and the situations. But yeah, there's a lot of ways, I think, to try to do well in the market, and it's just a matter of just being able to sort of find out which style fits with you the best. And for me, it's just constantly learning and finding new and interesting situations. So
Do I remember correctly? Did you used to and you may still pitch, but you use the Ben Graham formula for valuation, right?
Yeah.
Or no?
Yeah. So
So what is that formula?
well, it's a simplification of a more complex growth formula. So there's a number of people have come up with various formulas for figuring out what growth stock's worth. And so Ben Graham came up with a simplification. It's 8.5 plus 2G is what the fair multiple of a company is, and the G represents what's the next 7 years growth rate going to be for the business. And then after that point, it's going to be going more towards a terminal, like a 3% growth. And so, and he did that when interest rates, when the AAA rate was probably roughly around 4%. So you have some people that make adjustments for what the interest rates are. And that's about where we are today. I think we're a little bit higher than that. So maybe a little bit of a discount on that. So, but that gives you, it's basically a simplification, and it's in the latest of the last security analysis he wrote before he passed away, which I think there's one in the 60s. I think he wrote that's specifically described in. But I found it helpful to just sort of say, okay, here's sort of a way to think about it. Now, again, that's sort of a formula that's best case. If everything works out exactly as planned, then here's what the best multiple is. But inevitably, there's something that doesn't happen. So, and what it's interesting, if you just look at the formula itself, what it would say is, okay, if there's no growth, it implies the fair multiple is around 8, about 12.5%, which is roughly the long term. And then it also says that, okay, if you're actually expecting negative growth, low multiples make sense, which makes sense too. So, I mean, and that's one of the things that when you look at, if you start out, a lot of times folks start on value investing, they look at these low multiple companies, but it's always tied to some kind of low or negative growth, and that's the danger. And the real question is okay, this is where it is now, but I think the most important thing is to figure out where you think it's going to go in the future.
Yeah, where is it going to be?
Yeah,
no
because
doubt.
Because if the growth still gets negative, it gets worse and worse, you're going to end up with zero. But if it goes the other way, if it's smaller and the growth keeps on growing, and I think that incremental concept is something I think that I've tried to incorporate more, and using things like that return on incremental capital has been a help to basically try to identify sort of the direction. Because I mean, the way that I look at like companies is to a certain extent sort of like a story or a movie, right? I mean, we know what's happened in the past, and we're trying to project in this movie, well, what's going to happen what's going to go on in the future. And so you're trying to sort of, it's more of a, a lot of the stuff that the static valuation multiples is like a snapshot, but you really need to understand the whole picture in the movie of what's really going on, and basically being able to try to estimate that is what we're trying to do. And that's why I think Buffett and other people, they focus on businesses that are very predictable, and it makes sense, because if it's predictable, then it becomes, I mean, I know John Huber's has had few I think tweets lately that have been interesting, where he says, and I've seen other people do this, not John, but there's a few other guys that have put some stuff out there on Twitter that talks about that, okay, I mean, Buffett's bought these days businesses, but he's bought them at decent, not really expensive multiples. He's paid like maybe mid single digits at most, maybe high single digits, low double digits, maybe mid single digits most in those businesses, And it's tough in normal times to find that, right? I mean, even today, I mean, I think there are some areas where you can find that growth, but it's just the question of, how, that growth. And some of the key things that I think are really interesting is if you look at situations like, you get situations where you can see like free cash flow conversion increasing. So what that really does is that turbocharges free cash flow, right? Because your EBITDA is going up by 10%, free cash flow conversion. It's just, and trying to identify those kind of situations, they're sort of on you have a fixed cost, and you basically incremental revenue, the incremental amount is going up. So I think for me, a lot of it's just trying to focus on that incremental piece of it, and talking with other people about it, and sort of see what they've observed. Like I said, I was talking with another investor a few days ago, and he was basically just saying, it's because I've asked him about cyclicality, he said that's really tough. He didn't necessarily, maybe there isn't an answer, because when you're dealing with those returns on capital like over 10 or 15 years, and the business cycle is really long. I mean, like for example, a company you can talk about all the home builders or the building type companies, right? These
Yeah.
guys have been on fire since after, they went through 2008, 2009, then it went down, 2011, 2012. But ever since 13, 14, they've just been going almost like on a trajectory that's, it was a little bit with bump with COVID, but they've been pretty much on an upward trajectory since then. And it's like, okay, how much of this is cyclical versus secular? And you're just like, it's a tough one to tell. And, whenever you think that, okay, the market's going to turn, then okay, there's a housing shortage, so these things just keep on going on, right? They just keep on going on. And at
Yeah.
what point is it going to turn and go back down? And when that happens in a sector like that, no matter how good of a company you are, you're all going to get hit by it, and everything's just going to go down. So that's I guess that's part of the challenge of just trying to figure out what's really. But then you take a look at a business like Builders First Source, and that business has
Oh,
totally changed.
I
It's
know.
an awesome business. I mean, it's just like, you just look at it, you just go, this business is totally different than what it was before. They've rolled stuff up, they've integrated software, they've done all this stuff. It's just like, man, this business has just become a monster. It's just.
Oh, dude. Bob Rabati, I'll never forgive myself for not listening to Bob. But whatever.
Yeah, I mean, I think I bought it like about 15 months ago or something like that. But I mean, I missed out on the big thing too. But the way that I've sort of come up with a lot of these things, I'm just saying, okay, a lot of these things are sort of like a train. And if I miss the first part of the train, I'm fine with it as long as the train keeps on going in the right direction, right? I mean, because I guess I've got this value investor, probably a lot of other people too. Oh, if I don't get the bottom, it's already up 100%. You're just like, okay, well, I mean, if the train's still going and it's up 100%,
Yeah.
you know,
I think this is the right take. I think you don't need to catch the first inning or state of the ninth.
yeah.
I think that's. I think trying to catch the first inning has cost a lot of money to a lot of folks. So
Yeah, because a lot of those don't turn out right. I mean, and it's interesting because if you look at like when you think about even like the portfolio process that Buffett and these other guys go through, right? I mean, from what I understand is the early parts when they first buy a stock, there's a huge amount of turnover in the first period of time before you actually see it, right? So they're buying stuff, it doesn't work out, and they sell it. And so all we're really seeing, we're seeing the residual of stocks that they've held on to for years because they know those work and then they just leave them alone, right? So in essence, he's got a process where he's coming up with all these stocks and buying these things. And I think my perception is, from what I've heard from people, is that there's a good amount of churn initially, and then if the thing isn't working out, he seems to be quick to get rid of it. But if it does work out, then he just holds on to it and lets it float and just lets it go up. I mean, and that may be the way to sort of catch this, they've got, in stocks, a small percentage of the stocks create most of the gains. And that may be a way to sort of capture that, is to sort of say, okay, here's the, I'm gonna churn through things. Things aren't working initially. I may have a big churn in my portfolio initially, but then the things that work, I'm just gonna let them run. And it's for for me as a value investor, that's been a tough thing to do, is to let things run. But sometimes I've learned a little bit of that, probably not as well as I should have, but.
Yeah, well, I don't know that there's any good answers, man. I think it's a tough game. I think that there's an element of winners win. And when a business has momentum and it's winning, just let it keep winning, because it's probably going to surprise you. But, it obviously depends on the industry and where you're at in the capital cycle. And, I also, the other side is I've held on to cable, and, I did that arguably too long. We'll see if I'm right or wrong long term, but would have been nice. I mean, I remember Kyler Hassan called me and we were going through some math, and Charter was at like 800, and we were just like, I don't know about this. And it would have been nice to just punch out and say, okay, I'll see you later. But whatever.
It's
learn.
Tough, like you're saying. I mean, I think what's helped me to sort of get a little bit more conviction on holding on to these things is really understanding where the growth is and how the returns on capital, are they growing, and are they continuing to grow, right? And that's a tough thing. And I know for telecom, for me, having done well early on in the business and later looking at the returns on capital of the business as being not that good, has sort of said that's a tough business to I guess get confident in, that it's going to continue to go up from that perspective. I mean, I think for me, it's a lot easier to feel confident in a business where the return on capital is high and it continues to grow. But it's different. I mean, like I said, when I started out, I was pretty much all telecom and media, and then now I'm down to pretty much the only things I've got left are special sits in that space.
Well, That may be where I'm going. I've enjoyed talking to you throughout your evolution of it. So we will continue to talk over the years.
Okay.
In the meantime, I'm going to let you go because I've had you for a long time today. But thank you very much for stopping by. I appreciate it, man.
No, it's been fun. Thanks.
All right, cool. Have a good one.
All right, catch you later.
But it's absolutely necessary.